Ladies and gentlemen, good day and welcome to the Shri Keshav Cements and Infra Limited Q1 FY2024 results conference call hosted by Kiran Advisors. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gopal Chandak from Kiran Advisors. Thank you, and over to you, sir.
Thank you. On behalf of Kiran Advisors, I welcome you all to Shri Keshav Cements and Infra Limited Q1 FY2024 Concall. From the management side, we have Mr. Venkatesh Katwa, Chairman, Mr. Virat Katwa, Managing Director, Mr. Deepak Katwa, CFO. Now, I hand over call to the Mr. Deepak Katwa. Over to you, sir.
Good afternoon, everyone. Hare Krishna. My name is Venkatesh Katwa, and I'm the Chairman of Shri Keshav Cement and Infra Limited. So, I'm audible, right, to everyone, Gopalji?
Yes, sir. Please go ahead.
So, I extend my warm welcome to you all for the Q1 FY 2024 conference call. Shri Keshav Cement and Infrastructure Limited is a Karnataka-based cement plant which has two business verticals, namely cement division and solar renewable power division. A cement division with a capacity of 0.35 million tons per annum and a renewable power capacity of 37 megawatt. To start off, cement demand is growing in the region of our presence, that is mainly of North Karnataka and Goa. We have reported a total income of 31.74 crore in Q1 FY24. The positive side is that we have witnessed, to some extent, controlling the fuel prices, which used to be a major concern in FY23. So the benefit of this, reduction in fuel prices will reflect in the future quarters.
The person you are speaking with has put your call on hold. Please.
Oh, okay. Sorry. The benefit of which will, of course, accrue in the following quarters. Strong profitability from the solar business and cost reduction in cement business have enabled us to report a 10% rise in EBITDA, while our EBITDA margin increased with about 440 basis points to around 32.36%. We have reported a net profit of 2.68 crore for the quarter, while the net profit margin stood at 8.42%. The cement division reported a sales of 23.31 crores, while the solar division reported 6.03 crores. The total EBITDA for quarter one was 10.27 crores EBITDA, and significantly solar is contributing around 10 crores in that EBITDA, with the balance of around just 27 lakhs contributed by power. This is considering that the captive consumption of power was considered at market price for calculating the EBITDA of solar. So, with the encouragement we are getting from the infrastructure-focused union budget, cement demand is set for its third straight growth with 7 to 9% jump, or expected around 425 million ton in fiscal 2024. In 2023, the total consumption of cement was around 398 million tons. Cement demand grew led by rapid execution in the infrastructure projects and strong traction in the real estate and the rural affording housing segments. This physical would again see the infrastructure and affordable rural housing segments propelling growth. The highest traction is expected from roads, where the outlay from the Minister of Road and Transport and Highways has risen by 25% on year. And this being a typical election year, there has been a history where the last year of the election typically tends to favor the cement verticals. So the outlook of cement division is very promising on the back of rising infrastructure and household projects. To meet the rising demand, we are executing capacity expansion from 0.35 million ton to 1 million ton by adding a modern kiln and a cooler equipment. The project cost for this is around 125 crores which is funded by Canara Bank, and the capital has been brought in since company has raised capital in April 2023 by issue of preferential and warrants in April 2023 for this project. The project is currently under execution and expected to be commissioned by June 30, 2024. The very main objective of this capex of the cement plant expansion is reduction in fuel and power consumption rate, thereby increasing the cement EBITDA per ton to the industry standards, which is around 1,200 rupees per metric ton. So the focus continues to be on reducing power and fuel consumption and improving EBITDA per metric ton of cement, matching the industry standards. We expect substantial improvement in revenues along with the cutting cost and optimizing profit on back of the robust demand growth and noticing that the fuel price have softened compared to preceding quarters. So we are optimistic on the demand outlook and expect strong growth in the coming years. So with this, I would like to conclude my initial discussion on the Q1 results. Now, I would be very happy to answer any questions if anyone would like to ask. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Anupama Prakash Bhutra from Arihant Capital. Please go ahead.
Thank you so much. My first question is regarding some data points. I don't know whether I've missed or not. Whether I've missed volumes and trade share. What is trade and non-trade mix? And the other thing is premium products share in trade sales. If you can let us know about that. The second question is regarding if you can elaborate on the progress of obsolete machinery and the plants which the company had the issue. I don't know. So if you can elaborate on that point. So these are my questions. Thanks.
Sure. So let me understand the question. You wanted the sales in trade and non-trade percentage, and you wanted to know the project kind of machinery or what and where, what we're going to do about it.
Yeah, correct.
Sure. So Anupama, most of our business sale is trade. There is a very minuscule amount of non-trade, and I would say that the specific percentage could be less than 2% or so. And regarding the project, the machinery and the specifics for that, a simple thing is the kiln that we have right now was the cement plant that we have right now was bought in the public auction in 2007. But the kiln, what was existing there, it belonged to 1980s. So we tried to modify it as much as possible beyond the point that the kiln or the infrastructure was fit for original capacity of 200 tons per day, which we have increased to about 800 tons per day. Because of that, what is happening is, having a technology which is as old as 40 years meant that our fuel consumption and power consumption is extremely high. Our fuel consumption is nearly 50% higher than the industry standards, when the power consumption is almost 50-60% higher than the industry standards. To give an example, the large industries, the most efficient industries can produce clinker in less than 700 kilocalories per ton of clinker, whereas we are consuming around 1100 tons of kilocalories per ton of clinker. Power too, we are typically utilizing 110 units of power to manufacture 1 ton of cement, whereas industry is already targeting around 55 to 60 units per ton of cement. Now this, beyond a point, we could not do any modernization. So what we are doing right now is we are installing a new kiln, a new preheater, a new cooler together, which forms or becomes a decisive process to reduce the cost of fuel and power, for which we are going to only modify, not exactly modify, put a new kiln, preheater and a cooler only specifically to address power and fuel consumption. Because we are doing that, there is automatic increase in the capacity of clinkerization, which is why we need to go for a new grinding equipment, which we are going in the form of vertical roll mill, which are supposed to be the most efficient, least breakdown, and also with the lowest power consumption. As of now, regarding the project and the executions, we have placed order for the entire machinery, and the first set of machinery is expected in November and December. So the commissioning will start, one on one. At least there are one section of the machinery is expected to be commissioned earlier, and then the final kiln and everything we're expecting to commission by June 30th. So that is the kind of progress that we are making right now. So I hope I addressed your question.
Yes, sir. Thank you so much for that explanation. And sir, if you can also give me volumes for Q1 FY24.
Sure. So the volume for Q1 FY24, right, you said?
Yes.
So it is about 56,000 tons in Q1.
Okay, thank you so much.
55,981, approximately 62% of capacity utilization. This mainly was because Karnataka had elections in mid-May. So typically after, beginning mid of April till mid-May election, the construction activity had slowed down, or at least the availability of labor is becoming a challenge. Apart from that, we have picked up after that, and the plant has continued to give good operations.
Okay. Thank you so much, sir. I'm done. Thank you so much.
Sure, thank you. Gopalji, any other question? Next. Gopalji?
Our next question is from the line of Deepika Chadda from Cognant Finvest. Please go ahead.
Hello.
Yes,
Deepika ji, please go ahead.
Yes, sir. I wanted to ask the sales growth of Jyoti Power, Jyoti Gold, and Keshav Cement brands.
So typically, most of our brand sells in the name of Jyoti Power and Jyoti Gold, and almost 30-40% in the name of Keshav. So in growth-wise, compared to the preceding quarter, it has almost remained same with a minor improvement. All the three brands have shown similar consumption patterns like earlier. So one is a 40 grade, another is a 50 grade, and then we also have a slag cement.
Okay. What is the current capacity utilization of solar power plant that is in Concall, Karnataka?
So typically, all the solar plants in the country, do have a capacity utilization of almost 99 to 100%, because it is not really dependent on any outside raw materials, purely dependent on sunlight. So in line with that, even our capacity utilization was over 99% for the first quarter and even the entire last year.
Okay. So are there any plans for capacity expansion in cement or solar?
Yes, Deepika ji. So typically, we are looking for expanding the cement plant capacity from 0.35 million to 1 million ton per annum. Mainly, like I explained in the discussion, to reduce the fuel and power consumption rate compared to what we have right now. So industry is giving almost 1,000 rupees EBITDA per metric ton, but we are struggling with less than 100 rupees EBITDA per metric ton. The only reason we are making a healthy EBITDA on the balance sheet is because of solar generation and sale of solars. So yes, we have the expansion is going on and is expected to be commissioned by June 30, 2024.
Okay, and solar power segment contributes how much to our company's overall revenue?
Revenue-wise, the Q1, it only contributed to 6 crore because almost 30% of the power is utilized in-house, intra-segment, for whose sales is not recorded in segment-wise sales. So typically almost, I would say, compared to the segment-wise revenue, so last year, it contributed to 25% of our revenues.
Okay. Are there any specific projects in pipelines that will impact our financial position?
No, with the capex going on, company will be borrowing funds from Canara Bank has already sanctioned the money to go for this capex, which is costing about 125 crores. So that 80 crores debt is expected to be landing on the books spread from now till about 1.5 years from now. And at the same time, our debt has gone down from 180 crores to 165 crores in Q1 because of the company's position to reduce the debt wherever possible.
Okay, so how we plan to capitalize our presence in Karnataka, Goa, and Maharashtra?
Capitalize on our position, and typically with the more spending that we are doing in the market, Q2 has already begun with a good note. So we are trying to get deeper into the existing pockets as opposed to going too far away. Even with the new capacity, even Pune and Bangalore could be in the range of our supply zone. However, cement is a product with very low value to weight ratio, which means that logistic costs do weigh down on the product. So basically what we will be doing is we will be focusing on the tier 1, or not exactly, our first primary market, which is within 200 kilometers from the plant.
So we have any long-term contracts or hedging strategies to mitigate our price risk, volatility risk?
No, with the capacity, with the small capacity that we have right now, generally, we don't get a benefit of very high either sides basically. So we are not bidding for the big, large government contracts because of our limited size. But once we make it a 1 million ton, we can, address the infrastructure projects and infrastructure contracts. In fact, we have got clearance from almost all the government departments, be it dam, canal, or even the institutional projects clear. But our limitation has been set basically because of the low EBITDA margins due to the old kiln capacity, plus limited marketing budget. So with this million ton expansion, we will have a sufficient budget, and we expect to increase our market share significantly.
Okay. So are there any specific cost-saving measures that you implement?
The major cost saving is going to come from our, fuel and power itself. Like I said, the industry is generating about 1,000 rupees EBITDA per metric ton. Our company is doing less than 100 rupees. So that huge gap of 900 rupees will be covered with this expansion. So apart from that, company is also thinking of alternative fuels. Some provisioning is being made in this capex in the design and the civil structure, wherein in future we could go for alternative fuels at least to 20-25% of the fuel.
Okay. So, sir, how do you plan to sustain or improve the EBITDA margin in future?
Technically, since most of the EBITDA is coming from solar EBITDA may not there is no disruption happening regarding solar right now. So, and the biggest changes what we have done compared to last year is company is using 100% petroleum coke. Pet coke is as a fuel. Petroleum coke is generally lower in cost compared to the regular coal. The modification we carried out, last year helped us to start saving, which is why we see some EBITDA margins growingly in this quarter because we have completely switched over to pet coke. And the management will continually think on other cost-saving measures apart from like what I mentioned, the alternative fuel. Trying to go for certain type of fuel which is low cost and can be used to a certain extent in the kiln.
Okay, thank you, sir.
Thank you, Deepika ji.
Thank you. Ladies and gentlemen, before we take the next question, a reminder to all participants that you may press star and 1 to ask a question. Our next question is from the line of Ananya Swaminathan, who is an investor. Please go ahead with your question.
Hello, am I audible?
Yes.
Yes. What were the key drivers behind significant changes in revenue and profitability?
So the key drivers, at least for the profitability, has been the switching of fuel from coal to petroleum coke. Apart from that, since the new 12 megawatt solar plant, which was installed, of course, in the April 2002, after the initial hiccups, the capacity utilization has been very, very sound and healthy. So these are the main driving factors which has helped us to increase the profitability. Only because of being in election time in Karnataka, the sales dipped. But in spite of that, our EBITDA margin increased on account of change of fuel and efficient running of the plant.
Okay, all right. And can you elaborate on strategies to improve revenue growth and increase the overall income in coming quarters?
Absolutely. So now that elections are done and dusted with in Karnataka, we are focusing on increasing the capacity utilization from current 62% to at least 70-75%. And with that, we could see a better revenue growth. And since the fixed cost and everything else is going to remain same, we're expecting a better profitability this year too.
All right. Okay. And what is the current debt position of our company?
So our outside debt is around 140 crores. The outside debt, I need to say, for the bank. Everything else that you see in the books is coming from the promoters or from the government as an interest-free loan, which is repayable after 10 years. So typical outside debt is about 140 crores. And the new debt, what is expected due to the capex is about 80 crores. But that 80 crores will not come on the books next quarter or this quarter so easily. It will be spread around 4 to 5 quarters from now. In fact, our debt to equity ratio has also gone down significantly. So it used to be more than 9 in FY22. It has come down to less than 6 or 7 in FY23. Quarter one, it has come down to less than 2.5.
Thank you, sir. So the line for Ms. Ananya Swaminathan has dropped. You move to the next participant. Thank you. Our next question is from the line of Yashwanti Kherkar, who's an investor. Please go ahead.
Thank you, sir, for the opportunity. And congratulating for expanding our EBITDA margin. That is really great. So I just wanted to understand, like you mentioned that we may be aware a lack of staff because of the election period, and that is why our production has been hampered. So what is the outlook you would like to give for the next quarter and for the year, FY24?
Definitely. So the typically production does not hamper. Production is controlled because of non-availability of construction laborers. It typically happens during election month, and which comes once in 5 years. So that had to contribute to a large extent for us reaching less than expected capacity utilization. So for the ensuing quarters, one thing is for sure, the fuel cost has softened significantly. So whatever softening we see of the fuel cost, we'll be able to see the benefit in a couple of quarters down the line because of the FIFO mechanism of counting the cost of the raw material. So next quarter and this year, we are expecting the capacity utilization to reach around 70%, and profitability should be improved compared to last year only because the fuel prices have gone down, the plant has stabilized, plus due to regular repayment, the financial cost also is going down. And with this, of course, the top line is expected to grow around 8 to 10%, and EBITDA margin is expected to improve further.
Okay. Okay, sir. And we have to take the loan from Canara Bank as we take for your proposed expansion. So what is the cost of debt we can assume for the same?
So as of now, the cost of loan is about 9.5% is what they have sanctioned. we are expecting it to go down as, in future, based on our discussion. Apart from the, changes that are repo rate by the RBI, our rating also is expected to improve because our ratios have been, has improved a lot in this quarter. And, once that happens, there is going to be further reduction in the interest cost, not only in this loan, also in all the existing loans too.
Yeah. There was another question of what is the cost of debt for the existing loan on the books? And when the
average, yes. So the average debt on the books is around 10.35% right now. Or about 10, not 10.35, it's a little less than 10%, maybe about 9.85% or so. The average debt across all the loans taken. And our current rating is BB+. So this BB+, we have got it on FY22 balance sheet. Since then, there has been a significant change in the ratios, which has gone from almost debt to equity from 12 to almost less than 3. And in Q1, it has gone down even further. So apart from that, your current ratios, everything has gone positive. The top line has gone up, the EBITDA margins have grown up. With this, we're expecting, at least that's the expectation what we have from the rating is to give a better rating. And if we get that kind of a rating, another 50 basis points is what we would reasonably expect.
So I just want to understand, now our EBITDA margin is really impressive, which is accounted because of your solar contribution. So once we are done with our expansion, I believe that whatever the power generation happens, that will be consumed internally. So in that case, how our profitability will be impacted?
So when I mentioned solar EBITDA, it is EBITDA, what we mentioned in my discussion is entirely not generated due to sales. So let's say in Q1, the entire solar sales entire sales due to solar division has come to around about 6.03 crores. Still, we have counted EBITDA of almost 10 crores for solar because the 6 crores we have got from outside. Almost inter-company we have consumed around 4.5 to 5 crores worth of power, which otherwise would have been an opportunity cost for the cement division. So based on that, with this line of thinking, the cement EBITDA should not decrease going forward. So typically what will happen is cement EBITDA, once we stop selling solar, the cement EBITDA will just get added to cement EBITDA. And the cement EBITDA, what I mentioned, 1,000 rupees per metric ton, this is excluding the cost of power. So once the cement EBITDA adds to it, our EBITDA per metric ton of cement is likely to go up beyond 1,000 rupees. So I hope it is clear, right?
Yeah, very much. And then this quarter we had reported the EBITDA from 32%. So post expansion, what is the rate we can safely assume for the company to report EBITDA margin?
It would be a hard nut to crack, but based on our calculations and futuristic, we would significantly improve the EBITDA margins by 20 to 25%. So currently we are reporting EBITDA margin of around 32%. We are targeting around 40 to 42%. At least that's what our estimate shows based on the current valuation of value of plant, cement sales and the cost of raw materials. This is mainly because again the power is going to be less than 1 rupee 80 paise to us, whereas the market price of the power is around 7 to 8 rupees.
Right. So I just want to understand how the demand in the area of our presence, that is Karnataka and Goa, is right now, and what are the expectations for the year?
So as being a typical finance, last year for national elections year in 2024, in the past record has always shown that election year always gives a very high growth for cement, typically because government is more focused on investing in projects which not only gives employment but also due to other various reasons. So with this thought in mind and with the robust growth that we are seeing for housing in rural areas, we expect this growth to continue all through the till the end of the financial year. So I'm pretty hopeful that after the monsoons are over, the demand is going to go up.
Okay. So, and now currently we have, I believe, the debt of around 140 you said, right, in the books?
No, outside, basically from the bank. Now, on the books, what we show includes the promoters' contribution or promoters' unsecured loans in the books. So books right now in Q1, it is showing 165 crores.
Okay. And out of our 140 from outside.
Correct.
Okay. And now we will take a further loan of around 80 crores and all for the project expansion.
Correct.
So that will not weigh on our balance sheet?
Not right now, because still the interest rate and the interest generated till the project is commissioned will be capitalized. So it will not be showing in the balance sheet till the commissioning is done. Once the commissioning is done, of course, the interest cost will come on the balance sheet, but also to mitigate that, the sales would have jumped. So if you look at the nature of this expansion, what is happening is we are increasing the capacity by almost 3 times, whereas our cost of funds is increasing by only 50%. So 300% increase in capacity, but 50% increase in, as even 140 crores is our, outside, 160 crores is outside debt right now. Mm-hmm. So if we increase 80 crores, your, finance cost will increase by 50%, whereas your top line increase by 300%. So that's the idea where our EBITDA margin is expected to be bigger than earlier.
Okay, sir. Thank you so much for your explanation and wish you the best for the future.
Thank you, Yashwanti.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. Our next question is from the line of Himani Nubam from Suraj Enterprises. Please go ahead. Himani, your line has been unmuted.
Yeah, am I audible?
Yes, ma'am. Please go ahead.
Sir, can you please share production and sales volume of cement for Q1 FY23?
So the sales figure I have is 55,991 and the production figures are around 56,300 tons. Since the storage capacity inside the plant is only less than 100,000 tons, so typically production and sales would not go far off.
Okay. We have seen expansion in the EBITDA margin. What is the outlook for the rest of the year? Is it sustainable?
Yes, it is likely to be sustainable because even these EBITDA margins we have, we are able to get it with the fairly high cost of fuel because the fuel consumed in this Q1 based on FIFO method, it comes from when we purchase fuel in October and November. So with the reduction in fuel prices, we are expecting to continue or even better the EBITDA margins.
Okay. And what factors contributed to 440 BPS expansion in EBITDA margin?
Typically, one is mainly that to some the changeover of the fuel. We were using coal earlier in last year in the beginning period. Since about June, July 2022, we are exclusively using petroleum coke. Petroleum coke is lower cost compared to coal, and a sudden modification that has been carried in the plant is helping us to achieve that kind of an EBITDA margin, which is likely to continue because we will continue to use pet coke going forward, which is used by almost all the cement plants right now.
Okay. What is the capacity utilization level of cement plant?
About 62% in Q1, mainly because we were expecting around 65 to 68% this quarter, but due to election impact, it has gone down. So we are targeting around 70% this year.
Okay. And my last question is, what was the cost difference between coal and coke?
Cost difference between coal and the petroleum coke?
Yeah.
So now if we talk, let's say we take for today, the cost of coal is around 2 rupee 20 paisa per kilocalorie, whereas petroleum coke is 1 rupee 40 paisa. So the difference is almost 40 to 50%.
Okay. Okay. Thank you so much, sir. That's it from my
Sure,
side.
sure, Imani.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Our next question is from the line of Suyash Singh from Index Securities. Please go ahead.
Hello. Good afternoon.
Yes, Suyash.
Sir, what is your per day capacity of cement production and also solar power generation?
Sure. So cement plant machinery capacity is 1100 tons per day, which translates into 0.35 million tons per annum. Solar capacity is 37 megawatts. Typically at full capacity, we would be producing around 180 to 2 lakh units per day.
Okay, sir. Okay. Sir, and also you have mentioned about working on alternative fuels such as bagasse and any other fuels. So any advancement on that, sir?
So typically what our first step we are achieving is the capex what we are doing right now. We are making platforms and certain civil accommodate usage of alternative fuel in future. In current stage, we are not adding any machinery. So once the capex goes online, then our next step would be to add the machinery for utilizing the alternative fuels and then use it directly. So that's a plan what we want to do. Apart from bagasse, we also can go for municipal waste, and there are some certain kind of dry items which could be used as an alternative fuel.
Okay. And sir, also till which quarter do we plan to close your new expansion plan?
So right now, capex has begun after the fundraising was done in April. So we started to work somewhere in the month of June. With that, we are expecting to commission by 30th June, or let's say from 1st of July 2024, Q2 of 2024, we would expect the plant to go online.
Okay. And sir, how are we working on increasing our current retail touch points, that is 600? So can it increase till next financial year?
Increase what you said?
Your retail touch points, your distribution.
The distribution, is it? Yes, it will. Typically what will happen is we will also start going for institutional projects, the government-related projects, the infrastructure projects, and also go for deeper marketing strategies by increasing the market share. So currently, due to limited EBITDA margins, it is not possible but with the expansion, then we get the EBITDA margins. We could go for a much more intense marketing and sales expenditures, which thereby will increase our number of dealers from 600 to say about 800 or 1,000, and then also increase our market share itself.
Okay. And sir, what is your sales team size?
What size?
Your sales team size?
I think our sales team is around about 18 people.
Okay. And sir, your budget for marketing as well?
Right now is almost, you can say, very, very less. I mean, it's very, very minuscule. We don't even give any, larger advertisements also. It could be less than 25 lakhs in a quarter.
Okay. So do you plan to increase in near future your budget?
Yes. Once we have the new capex in place, there's going to be a huge change in marketing and sales budget, which eventually, not only marketing sales budget, we will also have a deeper connection with the end market by, having contracts with the logistics and having contracts with the institutional buyers, the government-related projects, the big contractors. All these are going to come in line once we have a certain capacity on board.
Okay. And so your current manufacturing, the land that we use is owned or owned
all
by
the land for cement plant as well as for solar is entirely owned by the company.
Okay. Okay. And sir, it is operational all 365 days or few major?
Solar is operational all 365 days. The cement plant only during shutdowns where we have to fix the machine, typically only that time it is closed. Otherwise, cement plants are supposed to be running 24 hours. Once you fire the kiln, you cannot stop the kiln every day. It has to at least run for 2 or 3 months on a continuous basis.
Okay. Thank you, sir.
Sure.
Thank you. Our next question is from the line of Ananya Swaminathan, who's an investor. Please go ahead, ma'am.
Yes, sir. So my call was disconnected for some reason.
Yes.
Coming back to my question about debt, what is the typical debt repayment in one quarter?
So typical debt repayment in the entire year is about 18 crores. So one quarter would be around a little less than 5 crores. So about 4.5 crores.
All right. Okay. So to what extent have you achieved power cost reduction? From green power energy?
So currently we are producing power at around 1 rupee 80 paisa per unit. And out of this 1 rupee 80 paisa, almost 1 rupee 60 paisa is contributed because of interest cost. So once that goes off, as the repayment continues to push the debt down, we're expecting the power cost to go to less than 25 to 30 paise next 3 to 4 years down the line. So as of now, it is less than 2 rupees.
Okay, all right. So how do you plan to strengthen your position in the cement market and expand it?
So typically, as of now, the sales is generally divided into 3 areas. The primary market, which is where we want to be having the maximum presence. The secondary market, which is periphery to the primary market. And then we have a tertiary market where, if the cement is not getting consumed in primary and secondary, it has to go tertiary. Till date, we never had to go to the tertiary market because it didn't. We were able to, as much as possible, try to sell here in the primary and secondary market. So with the capex, what will happen is our EBITDA margins will increase, the profits are going to increase, and we will have a very healthy budget for sales and marketing expenditure, which we are not able to implement right now. So once that is done, we are looking for increasing our market share from current to at least 2.5 times of that. And after that, we always have a secondary market, which is like about beyond 250 kilometers from the production center. So with this strategy in place, management is pretty confident that once we have the capex in place and due to better margins, we will be able to give better pricing and absorb the market shares.
Mm-hmm. Okay. So, and about the competitive landscape, how do we differentiate its offering from competitors, our offerings?
One very strategic advantage what we have been receiving from all our existing customers is of quick service. That is mainly because our cement plant is located within 200 kilometers. So any cement which is delivered fresh, typically, I wouldn't say the quality is any improved or anything better like that, but generally it is much more drier and much more, it comes in a nature where it becomes easy to use for construction. So that is one thing which we always found having an advantage. Typically, all the major plants do have godowns where they store the bags and then pick it up from there and then deliver it. So once you store the bags beyond a certain period, it always tends to have some moisture in it, which is not the case in our cement. And cement market is typically positioned by tier 1, tier 2, tier 3 brands. Tier 1 brand is the large brand which are pan-India. Tier 2 are anyone between 1 million ton and above who have local presence or regional presence. We consider ourselves as tier 3, or rather market considers us as tier 3 only because our capacity is less than 1 million ton. So we are typically competing with tier 2 brands, and there is a delta price between our brand and their brand, which of course will start getting close once we reach to 1 million ton capacity. So with that strategy in place, we intend to increase our market share and which will help us to consume our production.
Okay. All right, sir. Last question on CapEx. CapEx will stop the plant for how much time?
Typically, the way we are doing it right now, the plant itself is not going to stop beyond, say, about 20-25 days. But for those few days also, we will have sufficient stock that sales will not be, disturbed. So from financial perspective, everything is going to be seamless. That is the reason we are not changing the existing kiln or changing the existing breeder. We are putting the new kiln, cooler, entire new section only. The only changes what we are doing is the feeding system and exit system has to be realigned to the new machinery. For that, we are expecting about 20-25 days shutdown what? It's a permanent shutdown of the old kiln.
Okay, sir. Thank you and all the best.
Thank you, Naviji.
Thank you. Our next question is from the line of Hemant M., who is an investor. Please go ahead, sir.
Hi, sir. Good afternoon.
Yeah, good afternoon. Please tell me.
Sorry, sir, I had joined this call late. I might ask a repeated question. First question is related to the current debt, sir. What is the current debt in the books?
On the books, the current debt is 165 crores at the end of Q1. And out of 165 crores, only 140 crores is outside debt to the bank.
So this 160 crores includes 80 crores, sir, or is it separate?
No. This 165 crores does not include 80 crores because the new 80 crores disbursement started in July. So the new 80 crores will come on the books spread within 4 to 5 quarters. So it will not appear immediately on the books. So and even the finance cost coming from that new debt also will be capitalized. So it will not even be, it will not be recorded as an expense on the books.
Okay. So what will be the current year finance cost for this FY2024?
So 9.5% is the new interest cost given to us by the bank. But we are also expecting an improved credit rating. With that, we expect the finance cost to go down by 50 basis points on all the loans, existing and new one.
So current existing ones are at 9.1%, right, sir?
Current existing one average is around 9.8%.
8%. Oh. Yeah, that's it, sir. I don't have anything else. Thank you so much.
Sure, sir. Thank you, Niji.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. As there are no further questions from the participants, I now hand the conference over to Mr. Gopal Chandak for closing comments.
Thanks everyone for joining the conference call of Shri Keshav Cements and Infra Limited. If you have any query, you can write us at research@kirinadvisors.com. Once more, thank you everyone for joining the conference.
Thank you. Bye-bye.